is me, and today we are going to talk about VA loan, tips for investing and owning real estate with utilizing the VA home loan benefit. This I call an insider's guide to help you use the VA home loan to buy real estate, invest in real estate, and ultimately create a safe and secure retirement. That's always the goal with real estate. Some people talk about income, some people talk about equity. For most of us, the main thing we're looking for is a safe and secure retirement. So today we'll talk about the benefits of ownership. You need to know what the benefits are. Some people don't realize what some of the benefits are because I want to make sure you look into every single one of them. Some things may apply to you, some may not, but you need to know what they are. The VA loan pros and con. That's right, there's only one con to the VA home loan benefit, and a lot of people it doesn't even apply to. So even with that con, it is dramatically the best loan in existence. We'll go through all that. Buying your primary residence. So using the VA home loan to buy your primary residence, we'll talk about that. We'll also talk about buying for investment. Can you buy homes with the VA home loan benefit that become investments? You definitely can. Also, you can buy multi-unit investments with the VA home loan benefit. A lot of people do not know this. It is something that you absolutely can do, and with the removal of the loan limits here in the beginning of 2020, this makes this a much more feasible thing, especially in San Diego County. There's also a leverage opportunity we'll talk about later. It's for the savvy folks. That's why I saved it to the end. It's some savvy stuff, but you need to know about it if you want to maximize the ability of utilizing the VA home loan benefit. Now we know that I run through these videos totally raw. I'm not editing this, so if I mess up, cough, whatever, it's going to be in here. So let's go with the first topic, benefits of ownership. First of all, what's the purpose? Why do we buy real estate? Why do we even want to do this? Is it because we can make money with it? Is it because we just hate paying rent? That sounds like a bad idea. There's lots of reasons why, but the main reason is because ultimately you want to have a home ownership, or what I call a retirement strategy. Now, you could call it a home ownership strategy, and you'd say, well, but that doesn't talk about retirement. But it does, and the data will show you this. You can look it up. When people are now keeping mortgages longer and they're retiring later, there's a direct correlation between how long you have a mortgage and how long before you can retire. People who pay off their homes retire because the big payment's gone now. They have options. So let's not forget what the purpose is here in buying a home and owning real estate. Make sure you have this part checked off first before you start doing anything else, because if you do nothing else, if you don't save any money, if you don't make any good investments, if you do nothing else but buy a home and own it free and clear, you are going to be okay. That's why we are proponents of home ownership. There's a potential tax advantage here that is significant. You can deduct the interest that you pay, especially if you're active duty. This is something to really look into because you have your BAH, which is given to you tax-free. You can then use it to buy a home and pay a mortgage, which is mostly interest, which you get to write off against your taxable income, which the BAH isn't taxable. So it's a humongous tax advantage that a lot of people need to look into. If whether you have or not yet, definitely do it. I'm not a CPA. I don't know why PowerPoint is upset with my spelling of principal here, because it is a correct spelling of principal. No, it is not your principal. It is a principal. Principal pay down. So principal being paid down is something that is guaranteed to happen. So every payment that you make, so the very first payment you make when you get a loan has the most interest in it and the least principal. But every month when you make the payment, a bigger portion of that payment is principal and a smaller portion is interest. So the longer you pay on your loan, the more you're going to pay it down. That is a real benefit that is happening. When you pay rent, obviously it just all goes away. There's no tax advantage for sure, and there is no principal pay down. So you do not get either one of these. The tax advantage is potential, may not apply to everyone, I have to say that. The principal pay down happens to everybody. So with the VA loan, it's an amortized loan. That is something that you are going to get in benefit. Now you also have an appreciation opportunity, and this is something I'm going to talk about in detail. The appreciation opportunity is that home values can go up. Now, when you're buying homes in different areas, I know this will be on YouTube, so people may see this all over the country. If you're buying a house in the Midwest, or like where I'm from in Missouri, I live in San Diego now, it's a completely different ball game. But some places the appreciation opportunity isn't as great as others. So I'm going to specifically speak to my area here, which is San Diego County. Now, in San Diego County, this is a great graph because it shows you what happened here, right? This is what was going on, right before the crash. So almost at the very top of the market, when the median price in San Diego hit 500,000, I remember this. It was like, what in the world is going on? So if you had bought up here, okay, and you lived through this horribleness, this crash all the way down to 280, but ultimately, this is where we were as of November 2019, right? So now let's take a look at the numbers. If you had bought in 2005 for 500,000 in June, and you just made it to November 2019, and these are averages right now, specific property situations, but just on average, just to give you an idea conceptually, that's a $6,785 a year in appreciation. So in other words, if you'd waited in 2005 and said, look, I missed this whole crazy crash, I didn't buy. Well, you need to have saved $6,785 a year since then in order to be where you would have been if you had bought a home and just held it. So if you didn't save $6,785 a year since 2005, then it's cost you money. Even though we had an epic collapse in real estate, it still cost you money to not buy. Now, that is the softer example. Let's look at here. What if you had actually bought at the bottom in January 2009, and just all of 2009 was a great opportunity. If you had bought anywhere in there, really anywhere through 2011, look at how much that is. Now, if you'd seen it down there and go, oh, there's too much blood in the streets, I don't want to pull the trigger here, you would have had to have saved, after paying tax on the money, $29,000 a year in order to have the same financial situation trying to buy a house now. That's how much money your home made you per year. So there is definitely an opportunity for appreciation. It's not guaranteed. If you had bought here and sold here, you would have lost money, right? So the key is long-term thought process. Is something we're going to cover quite a bit today, but I wanted you to see those numbers because even though we've experienced an epic real estate collapse in the last decade or more, decade and change, the numbers still make sense owning real estate long-term. So there's also the macro implications here that I want to make sure you're aware of. Supply and demand. Ultimately, the population on the planet is growing. However, the planet is only yay big. Therefore, there's only so much real estate. There's a limited supply. However, there's an increasing demand because of an increasing population. That is the type of investment scenario that you want to be a part of. A situation in which you know demand for the product is increasing and going to increase pretty much forever. That is the type of investment you want to be involved in, just in general. If you can find another one besides real estate, please let me know. All right, let's get to the VA loan pros and cons. Let's just get the con out of the way. How about that? VA funding fee. And this only if it applies. If you have any percentage of service-related disability, any percentage, then this does not apply to you. You do not pay the VA funding fee. If you do not, or if you're active duty and you don't have a Purple Heart, then you do have to pay the VA funding fee, which varies and it changes. It just changed again, so I'm not going to put the numbers up. This is something you can contact me. My information's on the left side of the screen the entire time here. You can email me, call, text me. My NMLS is 155010, as disclosed earlier. I'm a loan officer and a lender. So I know this stuff very well, but it does change, and I want this video to be good forever. So it does change. It's a small thing. It's included in the loan. So it's not like something you have to pay out of pocket, but it is a fee, and it does show up if it applies to you. If it doesn't apply to you, then the VA loan is such a no-brainer. It's beyond comprehension. And even with this, I'll argue with anyone about the fact that this is the best loan in existence. You get 100% of the purchase price. So you're buying a house for $500,000, you can get a loan for $500,000 plus your funding fee. That's how it works. It's crazy. So you can buy a home now, loan amounts go up to $2 million with the removal of the loan limit, no money down. Now, there's closing costs associated with a loan. You'd have to pay those, but you can also get those taken care of. I'll show you in a second. Lower rates. Rates are lower on the VA loan than they are on conventional loans. They're just lower. I mean, like for example, and I'm going to give you a raw example, I priced out the same scenario for an individual who was considering getting a conventional loan versus a VA loan. It was 0.5% lower on the VA loan. And no mortgage insurance. So not only are the rates lower, but you don't pay any mortgage insurance. Mortgage insurance is a horrible waste of money. It does nothing for you. It is completely for the bank. You are paying for an insurance for them, so they'll fund your loan because you don't have enough money down. And it sucks, but it is something that has to exist for a lot of people to be able to buy a house, especially if you're not VA eligible. You may have to buy FHA or conventional, and you don't have 20% down in San Diego. That's a lot of money. So mortgage insurance exists for that reason, but for VA, it's never there, ever. No mortgage insurance, ever. You'll never pay it. The concessions opportunity is one that's really neat. For people who want to buy a house and not put any money down at all, not even the closing costs, you can get concessions up to 4% from the seller. So if you buy a house for $500,000, you can make the seller an offer and include in there concessions from the seller to pay for closing costs up to 4%, which would be $20,000. They do not have to accept that, but it is something that you can do. Also, there's an opportunity, and this goes with any loan, to be able to take a slightly higher interest rate and use the funds from that in order to pay closing costs. So for example, if you qualify for 3%, but you take a 3.25%, you might be able to use $4,000 or $5,000, depending upon the loan amount size and what the pricing looks like, but you would get thousands of dollars to be able to use towards closing costs in the form of a lender credit. So there are multiple ways that you can buy a house without any money out of pocket. And this is one of the only loans where that's really possible. In fact, it's the only loan I know of where that's actually possible. There might be some obscure products somewhere, but as far as government loans are concerned, as far as anything Fannie or Freddie or Ginnie is concerned, this is the only loan I know where that's possible. Qualifications are easier. The way you income qualify and the way that you credit qualify, for example, we can do VA loans down to 580 credit score, which is not a good credit score, but it allows you to buy a home. When you buy a home and you get a mortgage, it helps your credit score quite a bit. Same thing with an auto loan, helps your credit score quite a bit. A lot of people pay off their auto loans and then their credit scores go down. They wonder why. The credit scoring model wants to see open, active, good accounts in good standing. And so qualification is easier for the VA home loan, which is great because it allows people who might be tight on income or might be tight on credit to be able to buy a house and get themselves into a better situation. So it removes one of those big barriers to moving forward and making progress in your financial life. Super, super cool. And then there's the IRRRL, and I'm going to spend a whole slide talking about the Magic IRRRL. What does IRRRL mean? Interest rate reduction refinance loan. You don't really need to know that, but there you go. It means that you can refinance very easily. That's what it means. IRRRL means easy. Okay, just think about it that way. You can refinance your VA loan once you get it. If rates get better, they need to get better by 0.5%. You need to be able to drop your rate by 0.5% and pass a test for recoup to make sure that you can recoup the benefits of the refinance within 3 years. So there's lots of protections for veterans to make sure that people aren't just having you refinance just for the sake of it. But there's no appraisal needed. It doesn't matter what the value of the home is. The value of the home could have gone down. Doesn't matter. Your income doesn't matter. There's no income checked here. You could have lost your job and have no income. Doesn't matter. You're just going to get the lower rate. That's basically what it boils down to. You do have to wait to the 211th day. So you have to wait 210 days. On the 211th day, you can close from the time that you got the first one. So you have to wait that. That's the only thing you have to do. You have to wait that amount of time, and then you can go back and you can IRRRL if rates get better. Or if you had to take a higher rate for some reason in the initial loan, then you can come back and you can IRRRL later. Pretty darn cool. Occupancy also doesn't matter. So let's say you buy the home and then all of a sudden, boom, you get PCS'd. Well, shoot, now I have to go somewhere else. I got to rent out this place. So you rent it out, right? Because you have a strategy in place. We have a home ownership strategy in place in case that happens. We're ready for it. We bought you a house to make sure that you got a house that actually rents for what the mortgage is for this reason. And then you have to move on, and now it becomes an investment property. Doesn't matter. Doesn't matter if you live there anymore or not. Does not matter. You can still IRRRL. You can still refinance and get the lower rate and save yourself that money. However, credit score is the key. So with all loans now, since the crisis, what's happened is credit score, or what they call credit risk-based pricing is key. So for example, if you're over 780, that's where you're getting the best rates for VA right now. And the tiers are there about every 40 points. So when you go down to 580, it's much lower, but it's not hard to make up the difference if there's a credit that's needed or if you want to pay points or something. So if your score is lower, but you still need to buy, and let's say you just want to do the loan once and be done with it when rates are really low, you don't have to pay a lot of points in order to get the rate down to where it would be if you had perfect credit. So it's not a huge pain point, but it is something that's important, especially with the IRRRL. If you had great credit when you got the original financing, you need to have great credit when you go to refinance it, or you may be back in the same boat. Okay, buying your primary. Let's dive into this. Everyone should do this. Everyone should have a homeownership strategy, should own their primary residence, because like I said earlier, if you do nothing else for retirement but this, and you pay this off, you're going to be okay. So everyone should do this. The key is to think long-term, and that's what I really, really implore you to do here. Think long-term. Make sure that you have a strategy that you are playing to that makes sense for your life plan. Think long-term when you're buying real estate. Remember the graph I showed you earlier? People who were thinking short-term lost money. People who were thinking short-term short sold their homes and ended up hurting their credit when they could have held on to it and made money, but they didn't because they were thinking short-term. So I want you to think long-term. Long-term always works for real estate. Always has anyway. Shouldn't say it always work in the future. I have no idea what the future holds. But historically speaking, going back to the beginning of time, real estate long-term works. Use your circumstantial advantages as well when you're buying your primary. And what that means is, let's say you might be a young couple, or maybe you have a young child, maybe you even have two young children that are 1 or 2 years old, but they're not going to be going to school for another 4 years. Or maybe you don't have any kids and you don't plan on having them for a while, so you're not going to need good schools for 10 years. Look at buying in an area where the schools aren't great now, but where there's money and resources that have been allocated to improving the school systems in that area. That undoubtedly will cause prices to go higher whenever school ratings go up. If there's a place that has elementary school that's a 4, but there's $10 million that's been allocated to it over the next 5 years to improve the school, rebuild it, hire new teachers, etc. All those things are done years and years in advance. This is where your realtor can really come in and help you make a good investment. You have a circumstantial advantage. You don't need the schools now. Therefore, you can buy in an area where the schools aren't great, but you know that it's coming. So you know the value of the property will increase. Ultimately, maybe you will decide not to have kids, but the property value will still go up because of the increased school ratings. So use any kind of circumstantial advantages that you have like that to your benefit. Try to avoid lots of transactions. I talked about the IRRRL earlier. You can do it 211 days. Make sure, whether you're refinancing or whether you're selling or moving up and all this stuff, just try to limit the number of transactions. Every time you transact, it costs you money, just like buying and selling cars. Every time you do it, there are going to be charges. There's going to be costs. There's really no way around it. There are some opportunities where you can refinance and do what's called a no-cost refinance, where you don't add any costs in at all to your loan and you just get the lower rate. But rates need to go down a lot in order for that to make sense. So just try to avoid lots of transactions. Don't buy the house and then refinance, 211 days later, and then, another year or two later, you sell the house, you buy another one, then you refinance that one. Just avoid lots of transactions. They do cost money. Just keep that in mind. Anytime you transact, make sure it makes incredible sense for you, because usually the best thing to do is to just not do anything. Just hold tight. Now, right now, because rates have dropped so much, a lot of people are in the 4s and rates are in the low 3s, or even we've locked some in the 2s. That's when it makes sense to pull the trigger. But don't be happy to transact. Just make sure it makes sense. A little extra goes a long way. Don't forget about this. If you make one extra payment a year, if you make 13 payments a year instead of 12, you cut 7 years off of your loan. You pay off your 30-year mortgage in 23 years. Thinking about 30 years to retire from now, if you're just buying your first house and you're going to retire when it's paid off, sounds like a long time. But when you say 23 years, that doesn't sound like nearly as long. I can clearly remember 23 years ago. 30 years ago starts to get fuzzy for me. So, it's funny how that works, but 23 just doesn't seem like it's that big. So one extra payment a year pays your home off in 23 years. Pretty cool. All right, let's talk about buying for investment. Live in it first. With the VA home loan benefit, you cannot buy an investment property. You have to buy a home that you're going to occupy as your primary residence. It's just the way it is. But the way it's written is that you have to intend to occupy it for 1 year as your primary residence. You have to intend. It doesn't say that you have to do it, but it says you have to intend to. So for example, if you go and you buy a place and your intent is to occupy it, and then you get PCS somewhere else and you never actually move in, you're okay. You're not breaking the law. You intended to occupy it, but you were unable to based on circumstances. So that's kind of the reality of it. With this, you want to begin with the end in mind. If you're buying a place that you know is going to be a long-term investment for you, but you're living in it first because you're using your VA home loan benefit, live in it for 2 years, Okay, you live in it for 2 years because there's tax advantages to that. Ultimately, if you decide to sell within the first 5 years and you've lived in it for 2 years, you can avoid capital gains tax on a big chunk of the money, if not all of the appreciation that you receive. So speak with a CPA about that, but begin with the end in mind, or you can call or text me. I know a lot about this stuff. And if it's the case that this is going to be a long-term investment, you're going to live in it, just know that, okay, hey, I may have to buy this investment maybe in an area I don't want to live, but this is a good investment. So, but I'll have to stick it out for 2 years here, because I want to live in it for 2 years, not just the 1 year that's mandatory or required for intention, but I want to live for 2 years because there's huge tax advantages to it, and I can kind of make sure the place is in good shape, make sure I know how much I'm going to be able to rent it for, and be make a good solid investment moving forward. So begin with the end in mind always, and ask yourself, is this a long-term or a short-term investment? Do I plan on trying to sell this for a profit because I think the market's going to go up in this area? I think they're going to redo the schools, or I think the the gentrification is just kind of slowly going this direction, and it's not it's not here yet, but it's coming. And as a result of that, now I'm going to gain some appreciation. So I'll probably sell it if I make that money in the short. Like if I can make a couple $100,000 in a few years, I'm going to take it. But then maybe if that's not the case, I have a good long-term strategy. So it could be long-term and short-term. It could be both. You could have a flexible situation where, like, what, if it goes up in value like I expect it to, I'm going to sell it and take my money off the table. I have a plan to reinvest, in something else. Or you could say, I'm going to keep it regardless, because I believe that over the long haul, this is going to be a great investment for me, and I can cash flow it pretty easily. So why would I mess with anything else? Why would I, if I can cash flow it? Who cares how much it goes up in value? I'm going to depreciate the heck out of the thing and get additional tax advantages as an investment once it becomes one. So there's a few different things to kind of think about there. And something that you should know as well is you can have multiple VA loans. Some people say, well, yeah, I don't want to buy a home, and then with it as a long-term investment, and then I'm there for 2 years and I leave, and then what am I going to buy for myself? Well, just keep in mind, you can have multiple VA loans. You can buy a house with a VA loan, and then when you leave that one, you can go and you can buy another house with the VA loan. We just have to look at your entitlement, make sure that you're eligible to do that. Most people will be. I've done it a bunch of times. I've never seen anyone who wasn't able to do it, but it is possible that you would not be able to get a second VA loan. So just let me know. Give me a call, shoot me an email, text me, whatever, and I'll let you know if that's something you can do. Most likely it is. So that's also pretty cool, right? So you buy the first one, that you have that one as a VA loan, then you buy another. What about a third? I've known of people who've had 3 VA loans, but that's the most I've ever heard. And it depends on entitlement, and sometimes you have to put a little bit of money down on that third one or whatever it may be. But what you can do is, if you're buying that third one and you have 2 VA loans and you can't use the VA loan anymore, then you look back at those 2 and go, okay, well, what should I do with these? Should I refinance one of them into a conventional loan so I can free up some entitlement so I can buy another primary? By that time, hopefully they've appreciated. You have the 20% equity, and you can do a conventional loan, and it won't hurt you. It won't cause you to have to take bad, financing terms. So there's multiple options on what to do when you get to that point. When you get to that point, by the way, though, you're going to be high-fiving me so hardcore. You're going to be in such great shape, and I'll be so excited for you. All right, buying multi-unit. This is the one that everyone wants to talk about. So many people don't know this. So you can buy up to 4 units. So 1 to 4 units are possible with the VA home loan. And ultimately, it has to be primary residence. So you have to plan on living there. We can't get away from that. But the cool thing is, you can buy a home. We're actually doing something really neat with a renovation company here, where they're helping us buy homes for veterans and then build additional units onto the properties. Super, super cool. Reach out to me if you're interested in that, and I'll tell you how it works. But it needs to be your primary residence. So you're living in one of the units. But let's say you buy a 4-unit complex, which you can do with your VA home loan, 100% financing, no mortgage insurance. Yes, all those things are still true. You just have to live in one of the units for a year. You have to intend to occupy one of the units for a year. So if you're buying a 4-unit complex and you really don't plan on living there or want to live there, you just have to live there for a year, or technically intend to live there for a year, right? And then you can move out. It becomes an investment property. You can still IRRRL it. You can still do all the things we've been talking about. Nothing's changed. This is all the same. There's no new rules now. Oh, it's multi-unit, change thing. No, it's all the same. So you have this huge opportunity here. Now, keep in mind, you can use rental income. So let's say you're buying a 4-unit that already exists and has renters in it. Okay, so there's renters in it, there's rental income, and you want to be able to use that income from the renters who are already in the property you're buying to qualify for the VA home loan. You can do that if you have, and this is a very loose interpretation, we just have to talk to underwriting, but you have to have landlord experience. Essentially, you need to have experience with roommates, collecting rents, doing things that are similar, even being on the board of an HOA. It's very loose. There's no real hard and fast definition for what is considered to be landlord experience. If you don't have something like that, then you can't use that rental income as income to qualify, unfortunately. Seems silly, but it's true. Even if you have leases and everything and rental history. But we can build a case with the underwriter on all those things. The VA wants you to be able to buy a home. They want you deserve the ability to buy real estate and to grow wealth for yourself for serving this country, and they want you to be able to do it. So this is one of those things where there's some flexibility, and we just have to kind of work through the underwriter on it. There is no loan limit. However, most banks are capped at $2 million. So $2 million is going to be the max. You need a minimum 700 credit score to get that. So it's one of those things where, there is no loan limit now according to VA guidelines, but the banks have really capped in the secondary market at $2 million. Now, $2 million, you can buy a heck of a multi-unit. Not just in San Diego, but anywhere in the world, really. Anywhere in the country, sorry. $2 million will get you there. So that's been huge. You can convert this to investment property after just 1 year. So you can technically take it, buy it with the VA home loan benefit, boom, roll it up into an LLC if you want, make it a full-on investment, do all that stuff. Just 1 year is all you need. And then it's completely an investment property. You can have a 4-unit with amazing financing, super low rate, no mortgage insurance, no money down. It's crazy. Just crazy. Hardest thing is going to be finding one. That's going to be the hard part. Getting one won't be difficult. Okay, now this is for the savvy folks. I want to preface this. This entire video is not an offer to lend, obviously. It's informational. I am a lender, so I can answer your questions. But there's no links to applications or anything like that in here. This is for savvy folks. I want to just sort of preface that, this is not for everyone. You'll hear me say this multiple times, but you can do 100% cash out through the VA. So if you have VA entitlement, doesn't matter what kind of loan you have on the home right now. You don't have to have a VA loan on the home right now. You can do 100% cash out, which means if you bought a house with whatever loan for $350,000 and it's now worth $550,000, you can get a loan for $550,000 and you can take that $200,000 in equity that you have as cash out to do whatever you want with it. Now, I'm not recommending that anyone do this unless you're a savvy investor and you know what you're doing. You've consulted someone like myself or someone who's done this and who knows what they're doing, and they've given you the thumbs up. That's a good plan. It's not something you want to get in the habit of, but if you're starting a business, if you have another investment, if you're going to go buy investment properties with that money, it is a good thing to do because it's better to have the interest on your primary home for most people tax-wise than to have it on another investment property where you might have to put 20% down or whatever, so you need a down payment. So you're not paying mortgage insurance and wasting money on that. So it can be really good for a lot of reasons. You're going to diversify your investments in a lot of different ways. You can go and you can buy a stock portfolio, you can buy bonds. For a lot of people, that's the smartest thing to do. And I can give you the numbers on this, but if you go and you say, okay, well, I can get 3%, right now on VA, which is, what many people have locked at here recently with APRs in the low threes, if I can get it for around that, then, and I can buy bonds over here at 5%, so I have compounding interest on my bonds at 5%. I have simple interest on my mortgage at 3%. Why in the world wouldn't I just cash out all the equity, which is doing nothing for me? It's just sitting there. You're not earning any money on your equity. Your home is going to go up or down in value regardless of what you owe on it. So, you're going to earn appreciation or not earn appreciation regardless of the loan amount that you have against the home. So if I'm going to take that money out of there and put it to work, I want to just make sure that it's something that makes sense. The simplest thing to do is just go bonds or even money market, and you get compounding interest which you can offset against the simple interest associated with the home loan very easily. And you can have it make you tons of money, tons of money over time. It's crazy. You can buy more property. That's something that a lot of people are doing. Taking the cash out, going and buying more investment properties, or just taking the cash out and then, shortly thereafter, maybe, IRRRLing the home, which is something you can do. Consolidating debt, something you can do. You can do whatever you want with the cash, right? You can IRRRL 211 days later. So when you do a 100% cash out loan through the VA, there is an adjustment to the interest rate that can be somewhere around 0.5%. So if rates were 3%, hypothetically speaking, and you did 100% cash out, the rate could be somewhere around 3.5%. For the cash out. So if rates stay the same, then 211 days later, you want to IRRRL and get the 3%. So that's kind of how it's a little ninja move on how you utilize the IRRRL and the 100% cash out to ultimately give yourself options and a leverage opportunity to leverage what you've built in your home to do greater things for you. Just make sure that it makes sense. Get multiple eyes and ears on it. People who know what they're doing. You can consult me on stuff like that. I just want to make sure that no one takes this and says, 100% cash out. I'm going to go buy a car. I'm going to go buy a boat. I'm going to go do something stupid. I'm going to pay for a wedding. Don't do any of that. You'll waste it. It has to be an investment. It cannot be a purchase of a luxury item. It has to be an investment. If you're going to take cash out of the equity of your home, it has to be an investment. It could be an investment in the property. You could say, hey, I'm taking cash out because I'm going to build more units on my property. Okay, great. Or I'm going to upgrade the home. I'm going to build another level and get ocean views or something. Great. That's an investment. Do not waste that opportunity. Okay. Today's reminders. Sorry, this has been a long one. Why do we want to buy and own real estate? Safe, secure retirement, home ownership strategy. Do not forget that one. There's no better home loan available to buy real estate with than the VA home loan benefit. Does not get any better. I'll debate anyone, anytime, anywhere, any venue, you name it. Have an entry strategy and an exit strategy with the VA home loan benefit. Remember what you were taught in the military. Always have an entry and an exit strategy before you pull the trigger. You need to know, what am I getting into? Why? What is my purpose? And if things go right, what am I going to do? But also, if things go wrong, what am I going to do? We need to know all of those things. Thanks for listening. Thanks for tuning in today. This was one I've been meaning to make this video for a while. A lot of people have a lot of questions about the VA home loan benefit. It's something that is a passion of mine to serve people in general, but especially to serve those who have served the country. It really means a lot to me. If you or someone you know would like some help or has questions, give me a shout. This is my contact information right here, my NMLS number, my email, and 2 random characters, T and Y here. I have no idea what that is. As you can see my number, I'll get that fixed. You'll have a great day, and I will see you soon.